Welcome, learners, fellow comrades. Today we want to focus on theory, accounting theory. That is accounting assumptions, accounting principles, and accounting conventions. For those who are new to the channel, rush to the YouTube channel, search Mr. M.Patrick, and subscribe to the channel so that we can continue together in this course unit of accounting. We did the introduction to it, and we covered the introduction part of it, and this is the second video of the same. Good. So I know majority, when you mention to someone that accounting, will say accounting is all about numbers. No, accounting is not all about numbers. There's much of accounting. Accounting is broad, because you realize that accounting will help you to even understand the profitability of the business, know the growth of the business, help you in risk management, help you in tax planning, help you in cash flow optimization, risk management, as I've mentioned, strategy, compliance, and financial transparency. Good, financial transparency. That is why I always say accounting is not only about numbers, but it is good. May it be the field you are in, you require to have the basic knowledge of accounting, so that you can be able even to know to track your expenses and your cash, how you are maybe spending. Good. So today, let us focus on accounting theory and on assumption, principles, and conventions. Maybe somebody can ask me why we are learning today accounting assumptions and principles or conventions. Good. You can get a question maybe for the learners that you explain the need of these accounting assumptions as incorporated in the conceptual framework. The need of this, one, is to increase user confidentiality. You know, when as I mentioned in the first video, that we are after you have prepared the accounting information, you'll present to the users. The users may be the government, the managers, the financial analysts, the lenders, suppliers that are in need of this information. So for us to increase their confidentiality, they have to know that there are certain rules or principles that govern us as we are preparing this. So they know very well that yes, as this information being prepared to us, this information is very accurate, and since it is being governed with a certain, it is covered under certain principles or maybe concepts. Good. At the same time, apart from the user, to increase user confidentiality, it enables people to do the same thing, that is standardize, or you can say standardization. Yes, because we tend to understand we are bringing what we call standardization in accounting. And to bring standardization, we are all going to adhere to these accounting assumptions and principles as we are preparing the accounting information. So the standardization will be there in every business. Give it an example, maybe an accountant calculating depreciation of a certain asset. So if this accountant just pick their own methods of calculating the depreciation, you realize this financial period or this trading period they pick this method, this another method, another trading period they pick another method. You realize there will be no uniformity or the standardization in their information. And that regard, we will lack what we call comparability. Comparability in a way that we cannot even compare the financial information from one trading period to another, or from one organization to another, thereby driving decision or coming up with the decision we will not have it. It will not be, the information will not be reliable for us, and thus we render that information to be irrelevant. Good. So we will start with the accounting assumptions. Accounting assumptions, as you have seen, I've indicated here, we have accounting assumptions. And the first accounting assumptions I look into it is called going concern assumption. or going concern concept. Good. This concept simply implies that the business will, as we are coming up with the business will continue in operation, existence in the foreseeable future. And there is no intention to put the company into liquidation. There is no intention to put the company to liquidate the company or to liquidate the business at any given time. Because we tend to believe that this business will be there today, will be there tomorrow, and will be there even in the future. How does these assumptions come in? Especially when you are presenting to the users. Let's say you are presented this to the lenders, the bank. You'll go with this concern or this concept with the accounting information to give the surety to the entity that this business is going to be there. In case you apply maybe for a loan of maybe 10 million that will take you maybe 10 years. A loan of 10 years. If you are under this concern, you will have build the confidentiality into the lending party. That you will be there in the future, you will still operate. And there is no way you are going to liquidate the business. Or you are not going to stop. Let me use a simple language. The jargon just for the liquidation, maybe somebody is asking, what is liquidation? Liquidation is just a process of closing a business. You close the business, and maybe the asset in the business, you distribute to the shareholders, or you sell out so that you can cater for maybe the loans and all that is needed to be paid out from the business. So we are operating with under this. When we are starting a business or any company, we are operating under this assumption that we are going to operate, we are there today, we are here tomorrow, and we will be there in the future. So the bank will be having the confidentiality in us, and it will guarantee us a loan of that even 10 years. So I think this one is very well understood. Very well understood. Good. Another concept and assumption, another concept we will look into, another concept is called time period assumptions. Time period assumptions. Time period assumption. Time period assumption. Good. Time period assumptions. Okay. You can call it also timeless principle. Okay. Regards to call it to it, but the second one, it is time period assumption. Good. So this is very easy. You realize that we will be preparing as we are going to learn. As this is the second tutorial, remember we will come at a place where we'll be preparing balance sheet. That is the financial position of the business, where we'll be showing the asset, we'll be showing the liabilities of the business, and we'll at the same time we'll be coming up, we'll prepare profit and loss account at the end of the year. Good. So you realize this information has to be provided to the users on time. Maybe you can provide this information on quarterly. You can provide it on quarterly. Or you can provide this information maybe half a year, quarterly, or half a year, or you can provide this information annually. So if you provide this information, because we tend to believe that assume that business has got life. And since it has got life, we have to report on it on various time period. So you can decide your business, you are going to report it maybe on quarterly, or you're going to report on half a year or annually. So you'll tend to believe when we'll be preparing maybe income statement, you realize we'll be saying maybe a profit and loss account as at 31st December 2025, 2024, 2023, or balance sheet as at 30th June, that is. So that is why we said time period assumptions. So our business will always be, we report or we give this in users, we report to the users depending maybe at a certain period of time, and it must be provided on time so that they can make relevant decision depending on the information you have provided to them. So in case you are in an exam, you just say refers to the need of accounting information to be presented to the users in time to fulfill their decision making needs, whereby you can because we tend to believe delay in provision of this information will delay also the decision making. Good. So that is time period assumption. We have also another assumption. As you are running a business, you have to know there's also what we call business entity assumption. Business entity assumption. Business entity assumption. Business entity assumption. As you are running the business, you have to know that you have to separate the owner's dealings or your personal doings, yes, separate from the business. That is what this assumption says. That what you are operating, you have to separate from your own dealings or the owners. Let's say you are, let me say, taking an example like maybe I'm running a shop of the food stuff. When I'm running the shop of the food stuff, I have to come and buy in that shop. Not that because it's my shop and it's for the food stuff, I just pick anything. I pick the bread, I go and use it even without recording somewhere. No. When you pick something like that, in case of it comes to happen that you have taken something in that business, you will record it as drawing. You will record it as drawing, not that one. You will record this as drawing. That's why when we will be preparing an income statement, you will see how we will be treating drawings in the income statement. Good. You will be treating it as drawing. But at any given time, you treat business separate from your own doings. Are you there? Anything that is in the business, let it maintain in the business. Anything that is personal use, let it for the personal use. But in case you take something from the business, treat it as drawing and record it in the books of accounts as drawing. So in a financial accounting, based on this assumption, we always say that personal expense incurred owner's business will not appear in the income statement for the entity. Good. So that is very simple one. So that you have to know that at any given time, business is treated separate from the other personal needs. Good. So if any personal expense of owners are paid out of maybe the business, it may now be considered as an drawings for the purpose of accounting. For the purpose of accounting. Good. So we have another assumption called money measurement. Money measurement concept. Money measurement concept, or you can call it measurability concept. If you remember very well, when we were defining accounting, we said very well that accounting is the process of identifying, measuring, communicating economic information to permit informed judgments and decision by the users. So measurement. And you remember, measurement is just very easy. You now break this to the units, to the currency, depending on where you are watching this. For those in Kenya, you'll have to, after you have identified a certain maybe asset, you will break it into, maybe you'll quantify it into currency. That is, maybe it cost maybe 1,000 Kenyan shillings. That is. So here in short, you you are valuing, you are trying to value all the assets that this one costs this one costs this. Are you there? So money measurement concept is just very simple, that what you are doing, you are trying to value the assets. You are trying to value the assets, because we said in accounting we only deal with those things that are required to be that has got monetary value. That has got monetary value. But just in case you find that there is something that must be appear on income statement, and it has got maybe no money, maybe it doesn't qualify to be quantifiable into maybe monetary value, and it's supposed to be communicated in the income statement, what we normally do, you will attach it to the what we normally call supplementary notes or the footnotes. Other books can refer to as accompanying notes. These are just notes that you will record somewhere, that so that you will explain the reason why it is not there, or the reason why it what is in the income statement. So it can appear under supplementary notes. So that is it. So just in case it does not meet the the threshold of the money measurement concept, well, that is you just record it under supplementary notes or the footnotes. So it will be good for you, so that we can show this will help us to understand how everything was derived under the flow of the business in that organization. So in case it does not meet the threshold of the money measurement concept, record it under the supplementary notes. Record it under supplementary notes. Good. So those are the accounting assumptions. Let us dive into the accounting principles very quickly. Accounting principles. Let us look into accounting principles. Accounting principles. And I will start with the historical cost principle. Historical cost principle. Historical cost principle. And a historical cost principle, it just states that assets are recorded at any given time. They will be recorded at historical cost. Asset in accounting, we always record it at historical cost. Let's say the amount that you use to acquire maybe a certain vehicle in the business, that is an asset. That is a fixed asset. Let's say the vehicle. So when I'm recording it in the business, I will record it. If I bought it at 5 million, I will record that 5 million. Yes, I tend to believe this vehicle, I will be using it in the business. It will undergo the depreciation. But at the end of the year, we'll also calculate what? Depreciation. But initially, what we do in accounting, record what? The initial cost that costed you to acquire that machinery or that asset. So that is why we are saying the historical cost principle. This states that you have to record in accounting. You first record the asset with the original price of that or original cost of that asset. So while recording an accounting, we record by this. Yes, if it undergoes the depreciation, we'll come and calculate the depreciation at the end of the trading period and come up with the closing net book value. And we'll also show it in the financial statement. Good. So that principle, just state that one. So that in any given time, assets, we tend to believe that assets are verifiable. So maybe the auditors can come in the firm. They will have to look into the receipt that the original price of this machine was which was that has been recorded in the books of account. If it was recorded 5 million, they'll have to look into it and verify depending on what it was first recorded. So that is why we are saying historical cost principle, since the assets are what? Verifiable. So yes, in case depreciation takes place, you'll do what? You'll come and record it later. Good. We have revenue recognition principle. Revenue, another revenue recognition principle. Revenue recognition principle. This is very easy from the word revenue. Under this principle, revenue is recognized by the seller when it is earned, irrespective whether cash has been paid or not. Underline that one. Either cash has been paid or not. Cash has been paid or not. Revenue recognition principle. Okay. So this principle, you can just say that instead that revenue is recognized by the seller when it is earned, irrespective whether it is paid or not. Good. We all know revenue. Maybe you can say the income. So let me use two examples here so that you can understand this. Let's take, for example, maybe you are employed and you are reporting to work on daily basis. Now, you see, when you report to work today, you'll be counted for that you have worked today, and you are guaranteed to be paid that day. No matter the payment, even if the payment you'll receive it at the end of the month, but at the end of the day, it has gone into the record that you, Patrick, reported to work today, and he is guaranteed of a certain amount of money. Yes, it will accumulate, then I'll be paid at maybe at the end of the month. So that's why we are saying cash paid or not. Are you there? So the income will be recorded. Let's put it an example for a seller now, the sole trader. The sole trader, let's say the sole trader has sold good on credit. When he sold good on credit, is not paid at that particular moment, at that particular time. So we will have to record that he has done what? He has been paid. He has sold goods on credit, but yes, cash has not been paid, but there is an income has come in. So he will have to record that. Though he will be paid later, but we will record it under this principle, revenue recognition principle. Good. We have matching principle. Another one, matching principle. Matching principle. Matching principle, we always say that matching principle, all the expenses that were incurred towards a certain revenue. So you got a revenue that up here. But remember that there are always certain expenses, maybe that can incur you while you are getting what? This revenue. So the matching from the word match. So we will match the expenses that you have been incurred here. The expenses, you match it with the revenue that you have maybe you have acquired that particular period. So while you are preparing your financial statement, you make sure that the expenses and the revenue that has been incurred in that period must match. Then you presented in the income statement of that particular period, at that particular period. So all the expenses that were incurred towards a certain revenue to be acquired, they are to be matched together with the revenue. Good. We have also accrual principle. Accrual principle. Accrual principle. Accrual principle for this case, accrual principle just said that income stroke revenue and expense must be recognized in the accounting period to which they relate, whether received or not. Whether received or not. The accrual principle. From the word go, I have said received, paid, or not. And for this case, the accrual principle, we are being told whether this expense, this revenue, yes, or these expenses, they have been paid or not. You have paid them or not, or this income that you are supposed to receive, you have received or not. It must be recorded in the income statement of that particular period that these things have occurred. If it has occurred in the period of financial period of 2023, let it be recorded in the financial period of 2024. 23. Good. But not come that and you come and maybe in case you have been paid maybe after 1 year, you come and record. No, we record it at that particular moment. That is what we call accrual principle. You record it in the period that has occurred. We have also consistency principle. This one we have even talked it somewhere. Consistency. Consistency principle for this case is very easy. Consistency principle. Consistency principle. Here we make sure that similar items are treated in a similar manner from year to year. Consistency. Making sure that accounting policies are observed from 1 year to another so that a comparability can come in. As I had mentioned it earlier somewhere, that here you just make sure that what you are doing, maybe the methods you are applying it in this financial period, maybe for this period, make sure that you don't change along the way. We want to see it even in the coming period, you apply the same. As I used the example of accountants, maybe calculating the depreciation. Let the method you applied in calculating the depreciation for this accounting period also use it in the next accounting period or trading period, so that comparability concept can come in, so that we can be able to compare. We'll be able to compare what you have acquired what you have done this period and to the next period. So the comparability will come in if you have applied consistency in whatever you are doing. Even consistency applies everywhere. Even what you are doing on your daily basis, make sure that consistency is there so that you can track your record well. You can track your record well. Good. We have a full disclosure. Full disclosure principle. Full disclosure. Full disclosure for this case, we are being told that it said that ensuring that financial statement does not have any omissions. You have to be very cautious that you don't give incomplete information. You have to disclose everything. You have to disclose everything in the accounting, in the financial statement, or in the income statement, or the balance sheet. But just in case it doesn't meet the threshold for it to be on the final income statement, what you normally do, you will do what? You will record it on the what I mentioned earlier, the footnotes or the supplementary notes. You will record that one on the supplementary notes, or you can call them the accompanying notes, so that when you are presenting this information to the users, the income statement, you also present what? You also present your supplementary notes to show that, yes, this one has not been recorded in this income statement because of 1 or 2 reasons that has been explained in the accompanying notes. Good. Let me wind up the principle. We still have, we have this one. Substance. We normally say substance. Substance over legal form. Substance over legal form. Substance over legal form. This is very easy actually, because I know very majority of us, we have engaged in hire purchase maybe in the business. You know, substance over legal form, it means that economic substance transactions and events must be recorded in the financial statements. Must be recorded in the financial statement. Yes, then rather than just the legal form. So under this concept or under this principle, it's very easy. Let me give you an example of maybe, let's say you have purchased an asset in an organization on hire purchase. So you have purchased an hire purchase that the ownership of in the principle, in the agreement, when you are purchasing things on hire purchase, the agreement is always that after you have made the final payment, then the ownership will be what? The ownership will be transferred to you. But This principle will always guide the accountants that in case we purchase the asset on the hire purchase, what you do, you will have to record that asset. You'll have to record that asset used under this substance. That's why we are being told substance, economic substance. We record it in the books of accounts so that we can, simply because this asset is going to be there with us. We are going to use it in the business. You know, we are going to use it in the business, so it will be there with us. So there's no way we are not going to record it, even though we are paying for it on hire purchase. What if it takes 10 years, you know, and depreciation is taking place also, and we have to account to show our financial, how the business is running under financial statements. So we record it. If you bought on a hire purchase maybe 10,000, for us we will record that 10,000, then and ignore the legal form. The legal form of the legal form is that the ownership will be transferred to you after you have completed maybe payments. What if you complete after 3 years? No, we just record the amount, but we ignore the legal form. That is that of the ownership. So that is what we call substance over legal form. Substance over legal form. So in accounting, we'll just record it. We record the economic substance of transaction and events in the financial statement, and we'll ignore the legal form. Good. So the last principle I will look into it. Let me look into the duality. Duality from the word dual. Duality from the word dual. Dual means two. Dual means two. So duality principle, it always the duality principle is just very simple. You have to know that in accounting there are two. In every transaction or in every event that you do in the accounting, it has got two effects. It has got the credit effect and the debit side. So when you'll be gauging in your transaction in the business, it will have a debit transaction and you'll have a credit transaction. So in case you have to make sure that you record well on the credit side, and you also record well on the debit side. That means make sure that you record in the relevant account. You record in the relevant account. Maybe somebody can give you an example of a transaction and the duality, so that we see how duality. Let's say we buy an equipment. Let me just say you buy an equipment on credit. Yes, you buy an equipment, or let me just say you buy an equipment on cash. I've taken my 2,000 Kenyan shilling from the business and went and I added an extra equipment. Now, remember, equipment is an asset, and cash is also an asset. This is a fixed asset, but this one is a current asset, cash. So, asset, it has increased. This one has increased in the business, and we always say that when asset increase in the business, you do what? You debit. And this is a cash, that is a current asset. And we always say that when asset reduce, because we are taking cash, the 2,000 from the business, meaning it is reducing from the business to buy the equipment. When the asset decrease, we do what? We credit. So you see now the concepts of the duality comes in. So when we'll be opening the relevant accounts I will open the equipment account and we will open the cash account. So when I'll be recording the amount for the equipment, I will record it on debit side, and cash I will record on the credit side. So that is what we normally mean the duality principle. So when accountants will be recording this transaction, they will record under that principle. But this one, we are going to tackle it more on when we'll be opening the account. So this one is scattered for you in a subsequent tutorial that are going to come. I will teach you how to open the accounts, balance them, and you'll be good to go. Good. So let's finish with the modifying constraints or the conventions. You know, Yes, we can apply all this, but in one, we can be limited also in one area that we need to make decision. We cannot be just limited to this principle, but it will require sometimes to do what? To ignore some of the principles and do what? And make decision and continue. Good. Let us just look into maybe two. So we can say modifying constraints. Modifying constraints. Constraints can put in bracket the conventions. Conventions. Good. As I've mentioned that maybe we may feel reach somewhere as accountants that or in the business, yes, we cannot say that, oh, now that we are limited to all these principles, so that our financial statements cannot take place, or we cannot prepare the reports because we are binded with these principles. This principle is making us not to prepare. We are looking under now modifying constraint of the convention. Under that, you'll have what we call we have what we call maybe prudence. Prudence convention. Let me start with that. Prudence convention. Prudence convention. Under prudence convention, it says that accountants should exercise. You have to exercise a degree of caution in the adoption of policies. So as you'll be doing those one, before even you adapt to this, you have to exercise a degree of caution. Cautiousness. Yeah? You have to exercise caution. Well, you must be very sober when you are preparing this information. So you are being told that accountants in this area, you are reminded to exercise a degree of caution in adoption of the policies. In adoption of policies, you know. In the cause that you don't have to overstate maybe the assets in the income statement. In something that maybe an asset costing 2,000, you record 10,000. You know, such a mistake, 10,000. Others, maybe an asset costing you understate. That is also overstate. Maybe you understate in case the liabilities we are supposed to pay. Maybe somebody 5,000. You say we are supposed to pay 2,000. So you see, you have to show some cautiousness when you are doing this. That's why we are being told under modifying constraints or convention, prudence convention, is that you have to be very cautious so that you avoid the understate and the overstate while you are preparing your financial statement. You are preparing your financial statement. Then another one we have cost benefit. Cost benefit. Cost benefit for this case, cost benefit, you know, when maybe you are presenting the information, maybe through the financial statement, the benefit, it will always do what? It outweigh the cost. When you see, let's say you are being told to give the full disclosure, in case there is something that is missing, and you see that that's something, yes, you have been told we are applying under full disclosure, but you see very well that this thing, yes, even if I don't, it cannot affect this financial statement, let me maybe accompany it to something else. Because you'll have looked into what we call cost benefit. But if the benefit, it will outweigh the cost, automatically you will continue with your financial statement to prepare it, then you will explain later maybe in the accompanying notes. So the cost benefit, you must be look into it before maybe ignoring to do something. Look the benefit on this side and then the cost on this side. In case there is a benefit, you know, at the end of the day, we want to see the report that is can help us in making what? Relevant decision. Good. Then the last one, I can look into the materiality convention. Materiality convention or constraint. This is very easy from the material, immaterial. Good. This is very easy. It focuses on the maybe less errors. Let's say an error that's occurred in the business. So you have to focus on the size of error. Here we are focusing on the size of error. Let me put this way. Here we are focusing on the size of error. Let's say an error that has occurred maybe for, let's say an error for that has this very small, that a small error that cannot affect the small error that cannot affect decision. You see, we ignore it. You see. So let's say we have a company that is operating, maybe a company that is operating, let's say a company operating maybe millions and making a profit of 10 million, and you 10 million, and you have just done what? You have missed maybe in the financial statement. You have done what? You have just missed to record maybe 10. You have understood with the 10,000. That 10,000 cannot affect the making decision. You see, or 1,000 cannot affect in making decision. But just say that is for the big companies. What about the sole trader? Sole trader is making a profit of 10,000, and you overstate that he has made a profit of 20,000. That is not a small error, and that one we will always call it what? Material error. A material error. This is a material error. This is an error that will do what? A material that has got enough to influence or to alter the decision. Material error. So for this, let's say for the sole traders, that 20K, we'll call it material error. Because this material error, why? Because this is a sole trader, and automatically this one we have overstated, and automatically it will affect what? It has the potential, material error. This one has the potential to do what? Potential to affect the decision of the business. We cannot say this business is doing well or not. So it has the potential to do what? To affect the decision, the material error. But immaterial error, now this it comes to, in this 20K, we put it to the big companies. Then maybe you understate 20K, and it's making a profit of maybe 200K. So this one cannot affect. We call it a material error because it has got no potential of us making the decision. You understate 20,000. So it means it has got no potential of affecting the decision of the company. So we call that one immaterial error. Good. I think we are done. We have looked into the accounting theory. So it's now good for us to do what? To go revision questions. And other revision questions you'll always get, maybe you can get, they can highlight the concept for you, the principles, and maybe the assumptions. Like they can say a sample question like you define the following accounting concept, and for each explain the implication on the preparation of the financial statement. So it's up to us to do what? Like you have been given going concern, historical cost, materiality. So it's up to us to understand what they mean. Good. So I think up to there, we are good. What you do, just subscribe, share to the others as we continue learning this course unit. And I believe we are going all to benefit. Before we start the practical part of this, I believe we understand what is needed of us and the rules and the principles that we have to abide with and to govern us as we continue learning. Good. So for today, I wish you all the best, and may God bless you wherever you are as we continue our learning together. Bye-bye.